Hey traders, Raghee here. Let's get a quick audio and video check-in for charts and coffee for Wednesday, December 23. Good to see everybody. Happy Wednesday, everyone. All right. Rocking some Honduras honey. This is really interesting. It's a somehow or other they processed the coffee beans with honey. It's a nice flavor. So that's what we got going on today in the coffee mug. All right, so welcome again to another episode of Charts and Coffee. Happy Wednesday, everybody. Good to see everyone. Okay, let's take a look at what we've got going on today. Now, just yesterday, I was doing a scan with, doing the ETF sector scan and looking at which ETFs are currently in the kind of mode that I would want to prioritize potential buys for. Now, one of the things that I like to do is just look at, let me see if I can bring this up here. Okay, let's see. One of the things I like to do is take a look at a number of sectors and their rate of change. Rate of change is what? Their trend. That's it. What kind of direction are individual sectors trending in, say over the last 6 months, last 3 months, even the last month. And some of the rate of change when you compare, say, utilities to tech, or compare energies to staples, right? Not that we're pitting them against each other, but you just look at certain sectors that have been moving higher throughout much of the year, and then sectors that are now accelerating as we go into the end of the year. And so when people ask me, where is the market favoring rotation? Where is the market favoring, say, some window dressing, right? For those of you that are unfamiliar with the way in which the market might prefer one sector to another, then of course the stocks within that sector as well. You can look at the trend and compare them. What's zigging and what's zagging? That's another way to look at it. So if I take a look at the way in which right now my expectation of the year end and what's going to surge, a lot of what I've got my eye on at the moment would be things like, maybe not discretionary, although I am quite bullish in the XLY and a number of stocks in the XLY. But I would keep an eye right now in terms of the question of, what sectors are we focusing on? Glenn, thanks for the question. XLK is definitely high on the list. XLF, definitely on the radar. And for sure, XLE. All right, XLE. So those three are definitely are three sectors, Glenn, that I would keep a really, really close eye on. So thanks for the question. All right, moving on then to, let's see. We're traveling the world. Fernando, you're traveling the world through coffee, honey, and all those tasty things. It's so true. I love grabbing coffee from different. I have a Indian coffee coming, which I really haven't ever tried before. And what else do I have coming? Well, I have my favorites, certain ones that I tend to come back to. But yeah, it's very true. It's very true. All right, moving on. How do I gauge which sectors are heavily weighted within the major index? Okay, in the indexes, which sources do you use? So, Ferdinand, let's go to, say, the S&P. So how do you know what sectors are heavily weighted within them? Well, it's one way to do it would be to look at the stocks and sectors that are heavily weighted within the coordinating ETF. So while it's kind of difficult to go find the S&P futures and look at, where the weighting of the stocks and sectors may be, it's far easier to do that in the SPY or the QQQ. So let's say we take a look at the QQQ, for example. The heavily weighted sectors here would be the XLK, the XLC, and the XLY. So yeah, this is for sure something that I think we want to know, and it's easy enough to discover if you go take a look at the individual ETF weighting, not try to find it within the NQ futures, but rather take a look at the QQQ. All right. Hey there, Alex. Hey, do you recommend playing the tide or the boats into the end of the year? All right. So for those of you that may not be familiar with a little bit of Ragheeism of tide and boats. All right. So this is the way that works. And equally important, Alex says, Vienna Peaberry. I love peaberry coffee. I got some Kona Peaberry, Costa Rican, and some Jamaican. I'm with you. I love a peaberry coffee. So, and by the way, for those of you that are not coffee kind of geeks like myself, it's just a smaller berry, hence the peaberry. They're being quite literal. All right, so boats are tide. So this is how boats and tide work. The way that I break this down, let's use that XLE that we were talking about earlier from Ferdinando's question. So I call the tide the larger group. That would mean, say, the S&P futures or the NASDAQ futures, or in the case of the XLE, this is the tide. It's the bigger group. In this case, it's the energy sector. It's the energy ETF. Then in order of weighting, what I do is I list the stocks and you know, I think by the time you typically get to about the sixth stock, maybe seventh, you're usually looking at a pretty high percentage in a high concentration weighted ETF. You're probably going to see the top handful of stocks make up the weighting of, and a much heavier weighting of the remainder of the ETF. But because it fits, and I like to take a look at more than just say the top 4, 5, 6 stocks, it fits really nicely to have 11 stocks, which takes you well into more moderately weighted stocks within a high concentration weighted ETF. Now, what does that mean? Gang, most ETFs and the indices too, sans the Russell, have very few number of stocks dictate the overall direction of the ETF. By the way, the market does that too. What is the market? The market is Facebook and Apple, Amazon, Microsoft, Alphabet, and Tesla. I mean, really, if you take a look like a pie chart of the markets, you'll notice you have about 6 or 7 markets, 6 or 7 stocks that are pretty much, because of their high concentration weighting in the NASDAQ, in the S&P, and in the Dow, pretty much dictating where the rest of the market is going. High concentration weighting is great for traders. It is great for investors in uptrends if they're heavily weighted in those names and in the ETFs that have those names. But overall, if the markets roll over, if and when we do see a significant correction where the Federal Reserve doesn't step in and the Treasury doesn't step in to actually, quite frankly, stop a very natural, healthy cycle. You know, I live in Florida, South Florida, and part of what has to be done, management down in, say, the Everglades, you have to have controlled burns. You have to, because otherwise, if we get a drought and we get a lightning storm, it's far, far worse because the density of the areas that normally should be thinned out are too high. In the end, look, we've seen this on both coasts. What's happening in the West, what's happening, you know, sometimes down here in the Southeast. And so controlled burns are a really important part of what we need to see happen to keep small fires from turning into big fires. The same analogy applies to the markets, gang. The longer we put off and the longer we keep injecting steroids by way of cheap money and a credit Uber cycle, at some point we will get a correction. Now, that doesn't make me a bear, and I'm not trying to be a fear monger. It's nature, gang. So right now, what's going to be a bigger thing is just to take advantage of tides, which are double green, to kind of go back to the question. And when you have a tide that's double green, play the tide. If you have a tide that's yellow, like the XLE, play the individual boats. So tide is the larger grouping, All right, this is your tide, and these are all boats. Okay, that's the way I look at it. In a choppy market, be a stock picker. In a trending market, play as much of the broader indices or broader ETFs as you can because of high concentration weighting. So I hope that helps. And that's the way I've done it. And I think that becomes, since '08, since we've seen the surge in popularity of the ETFs since the financial crisis, we're seeing more and more volume and more number of ETFs. I think this particular phenomena, and it is a phenomenon, it's a recent phenomenon, 12 years, right? It's a drop in the bucket when you consider the different trends and things that move the market. But this particular trend is likely here to stay, and one that you definitely want to keep an eye on. All right, and so yeah, for a big part of what I do is I'll look at different double green markets. That's a constant scan, by the way, gang. It wasn't but about a week ago, XLE was double green. It's still buyable, but the degree to which it's sold off, which I have to say is pretty dramatic, as you can see here. But the degree to which it's sold off has put it back into a little bit of chop, but with bullish bias. All right, how do I define green wave label versus red? Oh, what's the definition? Sure. Terrific question. Thanks, Jan. All right, so what makes the labels do what they do? The moving averages. So let me see here. Let me grab a notepad. The 4 important moving averages. All right, for me, the 4 really most important EMAs, exponential moving averages, are the 8, 13, 21, and 34 period exponential moving averages. Let me make this a little bit bigger for everyone to see. Okay, those are the 4 most important EMAs to me, with special emphasis on 34. So I separate that. You'll notice the label is 2 different measurements. You'll have this one here, all right, 8, 13, 21, and the second one, which is the wave. That's the 34. So this one is the wave label, because that's what I call the 334 EMAs that are on every single one of my charts. 1, 2, 3, 34 EMA on the high, on the close, on the low. All right. Okay, so with that being said, how do I define green versus red? It's the structure of these moving averages in relation to each other. So if I have bullish structure in the 8, 13, 21, 8, 13, and 21 are moving in a particular way, moving higher. In a red, 8, 13, 21 are moving in a specific way, moving lower. 34 then becomes a measurement of this moving average and its relation to those 3. So it's really the structure, the relationship of those moving averages to one another that paint the label a certain color. That's it. Yeah, that's it. So it's those moving averages, those specific exponential moving average, 8, 13, and 21 period, and the 34 period. Okay, so that's how we do it. That's how we do it. All right, so let's see here. Next question is, Janet, I don't play minors as a general rule. I'm not a fan. I don't mind to play gold when gold has good clarity, but as a general rule, I will not really play the minors, and I'll want to play them even less, quite frankly, when I don't have a good read on gold. So you look at GC or GLD. You look at then GDX, GDXJ, NUGT. There's a number of minors. But no, if I'm not interested in gold, I'm even less interested in minors. And as a general rule, I don't play minors. I think the idea that let's just not limit this to minors. Let's also discuss the relationship of crude with oil exploration, XOP, oil services, OIH, the energy, ETF, XLE. The idea that those are always going to trend with crude isn't necessarily true any more than gold and miners will trend with one another. So they've got the stocks and the commodities, of course, have a certain relationship, but they're not in as lockstep as history tells us. They may be. I mean, conceptually, it makes sense that they would be, but they typically aren't when you really get down to trading them. So I typically avoid them. Now, XLE, I don't mind to trade, not because I'm bullish in crude, although it helps, but I'm bullish in XLE, I'm bullish in OIH, I'm bullish in even XOP, because their structure is telling me I should be, not because I am looking to get long again as I was through most of summer in crude. So don't use the correlation too heavily. Keep it in the back of your mind, but don't rely on it too heavily when trading miners for gold or even exploration and the energy sectors for crude. All right, next up is, let's see, just bear with me here. I'm gonna get down to, yes, going back to those exponential moving averages, fib numbers, absolutely, absolutely. Okay, so, and Fibonacci numbers are the 8, 13, 21, 34, 55, 89, 144, etc. And yes, I absolutely do prefer to use those number settings for the exponential moving averages. You got it. Is there a correlation? Hey there, Janet. Is there a correlation between the labels and my propulsion dots? So the labels are really looking at the relationship of 4 exponential moving averages, right? And propulsion dots, which are these dots you'll see here on my chart. Let's take the green ones there, this green colored dot. Those green colored dots are the relationship between the 8 and the 21 and price. So there is a correlation in that I am looking at the structure of the 8, 13, 21 against one another to paint that first label of the 2 trade flags that I have. But then the propulsion dots, while they're using some of the same exponential moving averages, is a little bit more focused a look, where I'm now just looking at 2 of the moving averages relationship to one another and the way they're behaving around price. So similar, but a little bit more focused. Rather than 4 moving averages, we're focusing down to 2. And unlike the trade flags, which don't consider price, the propulsion dots do factor in a relationship to price. So there's some correlation, but not a ton. But there's definitely an overlap in the period settings. Yeah, you bet. So thank you for the question. All right, so let's see. Next, Enduro says, smash the like. Well, I appreciate that. Yes, thanks so much. All right, Peloton? Sure. And this kind of goes back to the question about some work from home stocks that I saw earlier. So thank you for that question. That work from home conversation is a very in-depth one, my friend. I mean, one that probably exceeds our time limits of our 20 minutes in the morning as we sip our morning cup of coffee. By the way, for discussions like that, Peloton, of course, would be one piece of that. That's a lot of what I do in some of the other things that I do at Simple, like my Sector Secrets Mastery. I mean, that's a much more in-depth discussion. And actually, right now, it's a pretty volatile one, too. As we see, let's talk about Peloton and also that question from Rishi earlier about work from home, the work from home WFH basket. It's going to be pretty volatile. It's going to be one that's going to be very sensitive to renewed lockdowns, renewed travel concerns and travel bans, and surges in COVID and things like that. So I think that's a pretty twitchy narrative. Peloton continues to move higher. And I think mainly because, well, look, it's a stock that's been strong since about April. It's a stock that's going to continue to benefit from work from home because of the nature in which folks aren't going to the gym and they're working out from home. Good luck buying exercise equipment of any sort anywhere. If you happen to have been a publicly traded company selling exercise equipment, you were just, look, I'd rather be lucky than good. I'd say Peloton's a lot more of the former than the latter, but I'll take any mixture of both. So this is going to be a pretty twitchy narrative. As how much longer will this last? Now this is really a parallel narrative to the concerns around COVID. And this stock will continue to reflect probably a behavioral change more so than a well-run company. I'm not bashing Peloton at all, but it just really is. This move is very much, gosh, gang, this is luck. This is being the right stock with the right type of product at the right time. So I don't mind to play Peloton, but it has gone very parabolic. And so while on one hand, parabolic markets played with momentum are one way to do it, I think a lot of folks, let me use another example that is not work from home, but a parabolic market. Look, gang, markets are parabolic until they're not. So folks who thought, well, we're going to keep punching up to higher highs after Tesla punched up to, as you can see here, 695, almost 700 on the 18th, here it is pulling back. So who's to know whether or not a momentum trade is going to continue to behave with more momentum higher and higher and higher, which is really the epitome of greater fool theory. Not a disparaging thing, just that's like the psychology. That's the name of the psychological reality of momentum trading. But then you have this pullback. I'd rather buy the pullback. I'm not a big fan of momentum breakout buys. And you're kind of in a Tesla on the 18th of December position in Peloton. So I don't like to be up buying at highs like this. That's a general rule. So, and that's the only way that I think that we can really confirm that well would be with volume. Use momentum and high volume confirmation as a way to reduce, right? Or reduce the likelihood that you're the greater fool in the whole greater fool theory scenario, or to increase the probability of continued movement higher. Volume is going to be sort of the fuel in this rocket ship, if you will. Or, humor me, wait for a slight pullback, just a slight one, okay? All right, so gang, just like that, boy, this 20 minutes flies on by. Thank you as always. Get your questions in early. I try to go right down the list. Some of these questions, of course, they're going to be limited. We have 20 minutes together here each morning. But do check out my countdowntrader.com newsletter. And you can also check out what I'm doing over at the Sector Secrets Mastery, which is at simplertrading.com/sector. And you can see more in-depth coverage and my actual trades. And we get together 3 times a week to discuss watch lists and setups and my actual trade setups around the conversations that we're having here. So gang, thank you as always for your time. I hope this time sipping some coffee together with our trading community is beneficial. I appreciate the time. We're going into the holiday week. And so we've got Christmas day after tomorrow. We will have a session tomorrow, of course. As always, thanks for being part of the community. I'll see you tomorrow, okay? Be good to each other.